reverse mortgages?
Yeah, we do reverse mortgages. So you need the age of the borrower. You also need the value of the house and the current loan amount. Okay. You don't have to have a free and clear house to do a reverse mortgage. You can have a loan on it. Okay. Lots of questions on the test about referral fees. Okay. What does HUD define as a referral? Is it a lead generation company that's charging per lead generation company charging for loan amount, lead generation company charging per telephone call, or lead generation company worker providing information on a broker to a customer? Okay, let's think about this question. They want to come down on why is it prohibited or what's a red flag. Okay, so that's their... Is it illegal for lead generation companies to charge per lead?
No.
Do you guys buy leads? Yeah. You buy them from the title company, right? Is it illegal for lead generation companies to charge for the loan amount? How about for the telephone call? No. Live lead transfers. So the correct answer is a lead generation company worker providing information on a broker to a customer. Okay? That.
Information on a broker to a customer?
Yeah.
So the answer is 4?
The answer is 4. Hi, go ahead. You need a loan? Go ahead and call this customer. You're actually referring the business. Okay? That was on the test. What are the Fannie and Freddie Mac rules regarding an owner-occupied purchase of a fourplex to qualify for the self-sufficiency guideline? That's a lot of keywords, huh? I heard fourplex, self-sufficiency, Fannie and Freddie. That's a lot of words. Okay, let me give you some background information. I did a loan for a customer. He bought a 4-unit property, Santa Clara, about $580,000, because those things are pretty good. They're really cheap right now. He only had to put 15% down. Okay, going FHA. Fannie and Freddie have similar rules. It's called self-sufficiency. Self-sufficiency means that if they were to foreclose on the property, what is the total rents for each of the unit, and will it cover the mortgage? That's what self-sufficiency is. Does that make sense? Okay. So this is one of those ones where you just have to memorize it. Okay? The answer is that the rents must be greater than the mortgage payment. That's how you define self-sufficiency. Okay? So imagine the homeowner were to foreclose or to something were to happen. Does the property by itself qualify? That's called self-sufficiency. And for FHA, you can buy 15 down, but FHA requires owner occupancy. But you still calculate the self-sufficiency as if the person was not moving into that unit. Okay? Prepaid finance charge. Everybody know this? What is the abbreviation for prepaid finance charge?
PFC.
PFC, right? That's on the good faith estimate. A prepaid finance charge consists of loan origination fee, processing fee, escrow fee, or all of the above. The answer is all the above, which is really all the below.
The question that I got is actually the reverse of that. What is not included on the PFC and does not included in the APR, right? Appraisal and credit report are never included. Titles, insurance is never included. Surveys, those kind of things not included, right? Escrow fees, broker and lenders are always included.
Okay.
The title is not included?
Title insurance is not included. So if you have a
Okay.
title policy
Oh, the
holder or
insurance,
lender,
the insurance, title insurance.
title insurance, yes.
Okay.
Not the, well, title and escrow separate, right?
Oh, okay.
Yeah, in California they're the same company, but a lot of times they're actually separate.
So,
Yeah.
Okay, great. I mean, the truth in lending is not required on any business or commercial credit lines. How many people here do business or commercial credit lines? That's it. I've never done one, but that is on the test.
the answer is number 2, personal or
Okay. So the
Till is not required,
the
not-
till is not required on any business or commercial credit lines being used for any extension of a credit that occurs 4 times in frequency, personal or family transactions, business transactions. The answer is business transaction. Okay.
Because
Remember that even if you do a loan for a family member, you still have to fill out the truth in lending. This is a tricky one, okay? I can testify to this. I get in trouble as a broker if the customer does not live in the property. Okay, so in other words, if someone represent that they're going to move in, they have a certain period of time to move in. All right, how does the lender know that the homeowner hasn't moved in or has moved out?
Insurance, 90 days.
Well, they could go door knocking, right? But they can see the evidence of insurance that Lana does, and they can see a change to a landlord policy. Okay, so I'm telling you this not to work around it, but simply just be careful. Okay, when a homeowner says they're going to live in the property, make sure that they do occupy the property. Allowed per RESPA in terms of commission splitting must be the same every time. Referring a service provider as long as the work done is proportionate to the fee earned, or illegal.
Illegal.
Does everybody know what Form RFA is? Referral fee agreement. Done all the time, broker to broker, right? So think about that situation. You refer a deal to a broker in Hawaii or something, and they're going to do the work on the file, right? So they're actually going to earn it. So RESPA says that referring a service provider is okay, provided that the work done is proportional to the fee earned. Does that make sense?
The keyword there is unearned commission.
What?
Unearned commission is the illegal one. If it's not earned, it's illegal. Unearned.
Okay. How can one calculate the number of years it will take to recover the cost of refinancing a loan?
That actually appears in my test.
Okay, good. So how can one calculate the number of years it will take to recover the cost of refinancing? Okay. So you take the monthly savings due to the refinancing divided by the total cost divided by 12. Do you take the total cost divided by the monthly savings divided by 12? Do you take the monthly savings divided by the total cost times it by 12? Or do you take the total cost and divide it by 12? You take the total cost divided by the monthly savings divided by 12. This is also a subjective question, right? Because the borrower could have some other interest to refinance the loan other than the cost. That's why we're promoting right now heavily the no fee cost loans, because rates are so low that the borrower doesn't have to worry about the cost. You can get a 30-year fix at 4.375 with 1.8 rebate. You can then credit the borrower for the closing costs. You give them a free loan. You get lots of referrals. You know, so it's a great opportunity right now. A borrower buys a house for $125,000 by getting a loan for $100,000. Okay, how much is the down payment, by the way? $25,000, right? Simple subtraction. When the loan had a balance of about $75,000, he decided to lower the interest rate by 1.75. To do this, he had to pay a prepayment penalty of 1.5%. How much is this penalty in dollar amount? Okay, so a lot of numbers here, right? Let's look at the ones that are important. Is the 1.75% savings of interest rate, is that important? No, that's throwing you off. Okay. Is the borrower's price to buy the house important?
Yes. No. Yes. No. It's not. The balance. Balance of 75 billion.
Alright. So this is one of those ones. Here's how I approach it, okay? I know typically from doing loans, I know that a borrower can pay down the balance by 20%. Right? Okay, I know that the borrower can pay down the balance by 20%. So the original loan amount is possibly important. That means that I can pay the loan down to $80,000. Can everybody see that? Already? Okay, I can pay the loan by $80,000. The prepayment penalty is 1.5. So let me use some calculation here. 100,000 times 0.015. That's $1,500. That is an answer B. So that's a possibility here. So I take 1.5% times the original loan balance, and I get 1,500. Okay. Did everybody understand that?
So what was the calculation?
The calculation was the original loan amount times the penalty times 1.5.
Most of the time it will be based on the original loan amount. Sometimes it's a step down. So first year 3, 2, 1, you know. But now, no more anyways.
In other words, if you had a Long Beach mortgage loan, it's a step
There you
down.
go. Yeah, Long Beach mortgage 3 to 1, right? That's what we got before.
Alright. A loan calls for payments of $2,000 per month for the first 60 months and $2,300 per month for the remainder of the 30-year term. This loan is an option arm, a hybrid arm, an adjustable rate loan, or a fixed rate loan. Okay, so what happened? 60 months is how many years? 5 years, okay? So we know it's some kind of arm. These A is an arm, B is an arm, C is also an arm, D is not one of the answers. Okay, so let's look closely. The payment is $2,000 and then it went up after that, but it is amortized over 30 years.
Hybrid.
The answer is a hybrid arm. Okay, agree?
Yes.
Okay.
That's a
Hybrid arm is defined as a 525. It's 5-year fixed, amortized over 30 years. Okay. The pricing model used for subprime loans has been A, risk-based, B, index-based, C, uniform-based, or cost-based. Okay. Pricing model. Subprime means bad borrowers, right? Or bad credit. The answer is risk-based. Okay. The lower the FICO score, the higher the price. At closing, a borrower may deposit funds to establish reserves for which of the following: prepayment penalties, taxes and insurance, prepaid interest, or payment of late fees. Taxes and insurance, that's correct. Lien priority based on the respective dates of recording can be changed. Okay? Remember that when you get a loan, if there's two loans, you get one loan for $100,000 and you get a loan for $50,000. Which one is first loan, which one's second loan?
Depends when they were recorded.
Depends on when they were recorded. Exactly. If escrow screws up, records that $50,000 loan in first position, you got a problem. Okay? So lien priority based on the respective date of recording can be changed by an acceleration clause. What is that?
It's a demand for payoff.
It's a demand for payoff. Something happens, homeowner moves out, lender finds out, they say, okay, we are accelerating your loan. Okay, alienation clause, defeasance clause. The answer is subordination. Okay, when you do a loan and the seller loan. Okay, so they actually have to sell the loan to Fannie Mae. Therefore, they have to make sure that the homeowner actually lives in the property. Okay, so there are systems now in place. So if you try to do something fraudulent, or if the borrower does it.